Are you interested in finance? Want to understand what's happening in Belgian corporate finance? Dreaming of breaking into investment banking, M&A, or private equity? Then The Finance Show is for you. Every 2 weeks, we break down the most important corporate finance news in Belgium and around the world. We bring you expert insights, career advice, and the stories behind the deals that shape our economy. Whether you're a student looking to break in, a professional staying sharp, or simply curious about the world of finance, this is your access point to Belgian corporate finance. The first episode drops February 23rd on Spotify. The Finance Show, your one-stop for Belgian corporate finance.
Welcome back to The Finance Show, Belgium's podcast for corporate finance news, insight, and career guidance. The goal of this show is simple. We take what's happening in Belgium and global corporate finance and we make it accessible, relevant, and useful. Whether you're a student trying to break into the industry, a professional wanting to stay sharp, or just someone curious about the Belgian business landscape. And today I'm joined by Jules, who will be asking the questions that hopefully are on your mind too. This is our second news episode, and we've got a packed one for today. We're covering 4 stories. First, we dive into one of the biggest deals in Belgium real estate history, the merger between Aedifica and Cofinimmo, which is on the verge of creating Europe's leading healthcare property investor. Second, we look at what's cooking, the Belgian food group behind those Casa lasagne, and why its controlling families want to take it off the stock exchange. Then, we move to the Belgian tech world, where investment firm Syndicate One just closed a €22 million fund to back the next generation of Belgium startups. And finally, our global story, the Hollywood battle for Warner Bros. Discovery is over. Paramount Skydance won, Netflix walked away, and the market loved it. Lots to get through. Jules, let's get into it. As mentioned before, today I'm joined by Jules, who will ask the questions about the deal we're covering. How are you doing, Jules?
Hello everyone and hello Maxime. Well, I'm super excited. I'm really pleased for this invitation and I think we will make it the best of it. So let's get into it.
Yes, so first story for this week is a big one for Belgium real estate and honestly for European finance more broadly. We're talking about the merger between Aedifica and Cofinimmo, 2 Belgian real estate companies that are in the process of coming together to create what will be the largest listed healthcare real estate investor in Europe. And this week, we got the news that the deal has effectively crossed the point of no return.
Eventually, before we get into it, can you set the scene for our listeners? Who are these 2 companies?
Absolutely, Jules. Because of the background here is super important and even more interesting. Let's start with Cofinimmo, the older of the 2. It was founded in 1983 as an investor in office real estate in Belgium. But starting around 2005, the company made a major strategic pivot towards healthcare real estate. You can think about nursing homes, care facilities, medical office building, that kind of things. Today, healthcare assets represent about 77% of Cofinimmo portfolio. The company has been listed on Euronext Brussels since the early 90s and joined the BEL 20, so that's the index of the Brussels Stock Exchange, back in 2003. Today, it's building up its portfolio to €6 billion, spread across multiple European countries. Then you have Aedifica, the younger and more aggressive of the 2. Founded in 2005, it started out in residential real estate. But over time, it made an even more complete change than Cofinimmo. Today, Aedifica is 100% focused on healthcare real estate. No offices, no residential, nothing else. Just care homes, assisted living, senior housing across 7 European countries. Also listed on Euronext Brussels with a portfolio of around €6 billion as well. So you have 2 Belgian REITs, and for listeners who are not familiar with the term, REITs, so R-E-I-T, stands for Real Estate Investment Trust. It's a specific legal structure that allows companies to hold and manage real estate in a tax-efficient way. They distribute most of their income as dividends to shareholders, and these 2 REITs are essentially doing the same thing, in the same sector, in overlapping geographies. Therefore, a merger makes a lot of strategic sense on paper.
But so Maxime, how does this deal happen? Can you tell us about the timeline of this deal?
Yes, for sure. The first move came on the 1st of May 2025 when Aedifica made an initial proposal to Cofinimmo. It wasn't a hostile takeover, more of a formal approach, but it wasn't entirely smooth from the start either. The chairman of Cofinimmo at the time described it as having a difficult start, which suggests there was some negotiation around the terms. By early June, both boards has reached an agreement and unanimously endorsed the deal. That's important. Unanimous board approval signals that both sides are genuinely aligned, not just accepting the terms. The structure they agreed on is what's called an all-share exchange offer, or in French, an OPE, offre publique d'échange. Importantly, no cash change hands. Instead, Aedifica offered its own newly issued shares to Cofinimmo shareholders in exchange for their Cofinimmo shares. The ratio agreed was 1.185 new Aedifica shares for every Cofinimmo share. So if you held 100 Cofinimmo shares before the deal, you would hand them in and receive 118.5 new Aedifica shares. The offer opened around September 2025 after regulatory clearance in Belgium, France, and the Netherlands and ran through until this week.
But what did we learn additionally this week?
Yes, so this week changed everything. Aedifica announced the result of that exchange offer. They managed to gather 79.6% of Cofinimmo shares, so essentially 80%, and that's a decisive result. The minimum threshold they needed was 50%, so they cleared it comfortably. In addition to that, crossing 75% is particularly significant because that's the threshold you need in Belgium to push through key corporate decisions at a shareholders meeting. Things like approving a merger, changing the article of association, and other things like that. With 80% in hand, Aedifica now effectively control Cofinimmo. The formal merger still needs to be ratified at the extraordinary general meeting of both companies expected later this year, but at this point, that's essentially a formality. Aedifica holds the vote to make it happen. Shareholders who tender their Cofinimmo shares will receive their new Aedifica shares on the 10th of March, and those shares will carry entitlement to Aedifica next dividend of €4 gross per share.
So you mentioned the 80%, but what about the other 20% that didn't participate in this offer?
Yes, so that's a very good question and important for the people left over. The roughly 20% who held on for now remain shareholders of Cofinimmo as a standalone entity, but that entity is now 80% owned by Aedifica, so they're effectively minority shareholders in a subsidiary. Once the formal merger goes through, which should be before the end of 2026, Cofinimmo will cease to exist as a separate listed company, and those remaining shareholders will ultimately receive Aedifica share as well. There is also the possibility of a squeeze-out if Aedifica reaches 95%, similar to what we will discuss for What's Cooking story. This squeeze-out is forcing out the last remaining minority shareholders at a set price. But either way, the direction of travel is clear. Cofinimmo is being absorbed by Aedifica.
And Maxime, can you give us a bit more information about the advisor on this deal?
Yes, so the advisor lineup is pretty high profile, which reflects the size and complexity of the transaction. On Aedifica side, so the buy side, the financial advisor were JP Morgan and BNP Paribas Fortis. JP Morgan needs no introduction. It's the largest investment bank in the world and is a go-to advisor for major European M&A. BNP Paribas Fortis is the Belgian arm of the French banking giant, and they have very deep relationship in the Belgian corporate market, which makes them a logical local partner on a deal of this nature. For legal advice, Aedifica use STIB, which is one of the top Belgian 5 law firm and a regular name on large Belgian corporate transaction. On the sell side, Cofinimmo, the financial advisor were Goldman Sachs and Lazard. Goldman is another global heavyweight, historically one of the most prestigious M&A advisor in the world. Lazard is a specialist independent advisory firm well known for independent advice and valued in that kind of deal. They don't have a lending or trading business, so there is no conflict of interest. Cofinimmo Legal's advisor was A&O Sherman, which is a major international law firm. So you have generally tier 1 advisor on both sides, which tells you how significant this deal is in the context of European real estate M&A.
Well, thank you, Maxime, for this overview about the first deal. What about the second deal now?
Yes, so our second deal is one that caught a lot of people's attention in Belgium this week. And if you have ever eaten a lasagne from the supermarket, this one is probably closer to home than you think. We're talking today about What's Cooking, and more specifically, the controlling families behind the company who just announced that they want to take it off the stock exchange. A full delisting from the Euronext Brussels.
So, What's Cooking, as the name suggests, is of course a food brand, but what are they actually known for?
So What's Cooking is a food group based in East Vlaanders. Most people in Belgium know it through its brand Casa. Those are ready-made lasagne, pizza, pasta dishes you find in pretty much every supermarket in Belgium. But the company is bigger than just that. It's a B2C and B2B players in cold ready meals space and is been growing well lately. In 2025, the group reported revenues of over 468 million euros, which is up more than 16% from the year before. Net profit came in at 25.5 million euros, up nearly 24%. So on paper, this is a company that's actually doing really well right now. What's interesting is the history. The company was originally called Terbeke and it had two main divisions, a ready meals division and a processed meats division. In 2023, they made a pretty big strategic decision and sold off the processed meats division to a German investment fund called Aurelius for 100 million euros. And the market loved it. Since 2024, the stock has doubled in value, which is a strong signal that investors felt the meats division was actually dragging down the valuation of the rest of the business.
So, what is the deal here? What do the families actually propose?
Right, so the two controlling families, the Koopman family and the Van der Plum family, together own about 68% of the outstanding shares. The remaining 32% is traded on Euronext Brussels and therefore called free float. What they're proposing is a public takeover bid for those remaining shares at a price of 148 euros per share. That values the total operation at about 88 million euros for the minority stake. Now, the stock closed at 121 euros on Wednesday before trading was suspended by the FSMA. The FSMA is Belgium's financial regulator, and when trading resumed on Friday morning, the stock immediately jumped 18%. That makes sense because the offer price represents a premium of about 22% over the last closing price. That's a pretty standard premium for this type of transaction. You typically need to offer something in that 20 to 30% range to convince minority shareholders to tender their shares. The families have said they're hoping to acquire at least 95% of all shares, which is the threshold that would allow them to force out the remaining shareholders through a squeeze-out procedure.
But why would a family want to delist? What would they gain from doing this?
Yes, so as I mentioned before, the company is doing well. So you are asking yourself, why would a company delist if it's going well? And that's a really core question here. There are a few angles to it. First, the practical one. Being listed on a stock exchange is expensive and time-consuming. You have many different obligations from the regulators like FSMA, and you have to communicate every single material piece of information to the market. That creates a level of transparency that can actually be a competitive disadvantage. Your competitor, your suppliers, they all know what you're doing. For a family business that wants to move fast and stay nimble, that's a real constraint. Second, and this is more specific to What's Cooking current situation, They have a big investment cycle coming up. Their factory in Poland is being expanded significantly, but production from that new capacity won't come online until 2027. So in the short term, margins are going to be under some pressure. The CFO guided for EBITDA of 38 to 42 million euros in 2026, which is actually slightly below 2025 levels. If you're a listed company, that kind of outlook tends to weigh on your stock price. If you're private, you can just get on with the work without worrying about how the stock market interprets every quarterly number. Now, the downside of the listing, and this matters for minority shareholders and for the market more broadly. It's liquidity. Once you're off the stock exchange, there is no market for your shares anymore. If you're a minority investor and you don't tender your shares during the offer, you end up with a stake in a private company that's very hard to sell. That's partly why the premium is so important. It's a compensation for that loss of future liquidity.
Would you say this is part of a broader trend you're seeing on the Brussels Stock Exchange?
Indeed, Jules, absolutely. And this is what makes the story significant beyond just what's cooking itself. Brussels has been losing listed company at a pretty steady pace over the last decade. What's Cooking has been listed since 1986, 40 years on the exchange, and is joining a long list of Belgian family companies that have made the same decision. Just in recent years, you have had Greenyard, which disappeared from the exchange last September. Before that, VPK Packaging, Duvel Moorgat, Sioen, Telenet, Peridaisa, and the list goes on of all these companies that they listed from the Euronext Brussels. These companies are not struggling. Many of them were actually doing fine. They just decided the cost of being public outweighed the benefits of it. The trend is clear, and it raises real questions about the long-term health of Euronext Brussels as a market. When you lose names like this regularly, the exchange becomes thinner and thinner, even less liquid, less attractive for new listing. It's a bit of a vicious cycle.
So this will conclude deal 2, and it brings us automatically to deal 3, which is the last deal for the Belgian market this week.
Yes, indeed. Here we're covering the last news for Belgian market, and our third story this week is a very different kind of deal. We're moving from food groups and stock exchange to the world of venture capital and tech startups. This week, a Belgian investment firm called Syndicate One announced it had closed its second fund at 22 million euros. And while that might sound like a fairly niche piece of news, I think it actually tells us something really interesting about where the Belgian tech ecosystem is going.
Okay, but let's start from the beginning. What is this company about? Can you tell us a bit more about it?
Indeed, good place to start. Syndicate One is a Brussels-based investment firm founded in 2022, so still a young company. Their model is what's called a network-driven fund, which is a bit of a buzzword, but it actually means something specific here. The idea is that they don't just write checks to early-stage startups, they bring along a whole community of experienced founders, operators, and investors who actively help those startups grow. Think of it as angel investing, but structured and scaled up. You pool the money, you pool the expertise, and then you deploy both of them together. Their focus is specifically on Belgian tech startups, either company based in Belgium or startups funded by Belgian entrepreneurs, even if they have gone abroad. And they invest at the very early stage, what we call seed stage, which means these are often companies that are still finding their feet, maybe pre-revenue, maybe just a founding team with a strong idea and early traction.
But Maxime, what did Syndicate One actually announce this week?
So, they announced the first close of their second fund at 22 million euros. Now, a first close doesn't necessarily mean the fund is completely done. It means they have crossed a significant threshold and can start deploying capital while potentially raising a bit more on the top. But 22 million is already a big step up from the first fund, which was closed at 6.5 million euros in late 2024. So in the space of about a year, They have more than tripled the size of their fund. And what makes this particularly impressive is that they did it in a pretty tough global fundraising environment. They were oversubscribed within 8 weeks of their first pitch. That's fast, even in a good market.
But who are these investors that put their money in this fund?
Yes, thank you, Jules. Great question. And that's one of the most interesting part of this story. The investor base is a real mix. On the institutional side, you've got Sofina, which is one of the Belgian most prominent investing holding companies, as well as 4 government-backed funds, PMV, SFPIM, Finance and Invest Brussels, and finally Wallonie Entreprendre. So you have public money from all 3 regions of Belgium essentially backing this fund, which is a strong vote of confidence. But honestly, the more exciting part of the investor list is the founders. Syndicate One brought in over 120 entrepreneurs and operators, and many of them are founders of the companies that Syndicate One itself backed in the past. So you have people who received investment from the fund now turning around and investing back into it.
In what companies have they invested in the past? Are there any names we might know?
Yes, and a couple of them are generally impressive. The most notable example is Aikido Security, which is a Belgian cybersecurity startup that provide developer-focused security tools. Basically, they're helping software teams find and fix vulnerabilities in their code without slowing down the development. Aikido is now a unicorn, meaning it has hit a private valuation of over 1 billion. That's a big deal for a Belgian startup.
For previous deals, they use convertible loan agreements. Can you tell us a bit more about it?
Right, so a convertible loan agreement is a tool that Syndicate One actually developed for the Belgian market specifically, and it's worth explaining because it comes up in a lot of early stage investing. A convertible loan agreement, or CLA, is basically a loan that a startup takes from an investor, but instead of repaying it in cash, it converts into equity, meaning shares in the company, and they do that at a later stage, usually when the startups raise a bigger funding round. The key advantage is that you don't have to agree on a valuation of the company upfront, which is really hard to do when the company is not earning any money. You defer that question to later when there is more information.
Thank you, Maxime, for having informed us about the deal in Belgium this week. Let's now move on to the more international news.
Yes, indeed, Jules. And this week we're going to Hollywood for the global story of this week. As last week, we'll discuss the deal between Paramount, Netflix, and Warner Bros. So we're talking about the battle for Warner Bros. Discovery, and if you want the full background and how we got there, I would really encourage you to go back and listen to our first episode where we broke down the whole setup. But quick recap, Warner Bros. Put itself for sale. Netflix struck a deal in December to acquire its streaming and studio assets for $27.75 per share, and Paramount Skydance, backed by billionaire Larry Ellison, decided it wasn't going to accept that outcome and launched an aggressive counter-campaign to steal the deal. That's where we were last week, and this week we got the conclusion.
But before going to the conclusion of the deal, wasn't there any controversy around Netflix?
Yes, indeed, and it's a good detail to cover because it speaks to the political environment around this deal. Susan Rice, who was National Security Advisor under President Obama and later served in the Biden administration, sits on the Netflix board of directors. And in the current political climate, with the Trump administration in power and the Ellison family having well-documented ties to Trump, that became a talking point. The concern being raised here was whether Netflix's political positioning could complicate regulatory approval of any deal it tried to close. That a company with a board member so closely associated with Democratic administration might face a less friendly reception from federal regulators than Paramount, led by people close to the current White House. It created a narrative, even if it wasn't the decisive factor. In the end, though, it was quickly overtaken by events because Paramount came in with a new offer that made the whole regulatory question somewhat moot for Netflix.
But so how did Paramount manage to steal the deal from Netflix?
Yes, So on Feb 25th, Paramount formally raised its offer to $31 per share in cash for the entirety of Warner Bros. Discovery, the whole company, not just the streaming and studio assets as Netflix proposed. Before that, Netflix had offered $27.75 per share for the mentioned assets. The Warner Bros. Board looked at the two different offers and officially declared Paramount's revised bid a superior proposal. That triggered a 4-day window during which Netflix had the right to come back with a counter-offer. And Netflix's offer was effectively no thank you. They put out a statement saying, and I'm paraphrasing here, that at the price required to match Paramount's offer, the deal was no longer financially attractive for the company.
What about the market? How did they react to this news?
Yes, so right after the announcement that Netflix wouldn't bid again, the shares of the company jumped more than 10%. This could sound counterintuitive at first, and you would normally expect a company stock to fall when it loses a bid, but the market was essentially saying, good, you didn't overpay for this company. Investors were worried Netflix was stretching itself financially to win an asset at a price that didn't make sense. When Netflix walked away, the market basically rewarded the discipline. It's a good reminder that in M&A, walking away from a bad deal is sometimes the best corporate finance decision you can make. For Warner Bros., the final deal values the company at around $111 billion, including debts, at $31 per share in cash. So Paramount also agreed to pay a $7 billion termination fees if the deal fails to get regulatory approvals, up from the $5.8 billion that they previously proposed. It also agreed to cover the $2.8 billion breakup fee that Warner Bros. Would owe Netflix for walking away from their agreement.
So you mentioned us the details of the deal, but can you provide us more information about the advisor?
Yes, so the advisor lineup includes some of the leading names on Wall Street, reflecting the scale of the transaction. Let me go through each side. On Paramount side, so buy side, the lead financial advisor are Centerview Partners and Redbird Advisors. For those that don't know, Centerview is one of the most prestigious independent advisory boutique in the world. They focus only on M&A advice, no lending, no trading, which means no conflict of interest. And that's the same as Rothschild that we mentioned before. Then Redbird is also very interesting. It sits at the intersection of sports, media, and entertainment finance, so it's a natural fit for a Hollywood mega deal. Rounding out Paramount's advisory team are Citi, Bank of America, M. Klein & Company, and LionTree, the latter two being specialist boutique in media M&A. Citi and BofA are also providing a large chunk of the debt financing, $57.5 million in total, alongside Apollo, the private equity and credit giant. On Warner Bros. Side, the seller, the financial advisor are JP Morgan, Allen & Company, and Evercore. JP Morgan, we have already discussed them before. Allen & Company is a fascinating firm. It's a small, extremely exclusive boutique that has historically been the go-to advisor for media and entertainment transactions. And the third one, Evercore, is another top-tier independent advisory firm, very well regarded in M&A. According to the regulatory filings, JP Morgan, Allen & Company are each set to receive around $90 million in advisory firm for this deal alone. That's the scale of what we're talking about. And finally, Netflix advisors, they had Moelis & Company and Wells Fargo. These will unfortunately walk away with nothing since their clients lost the bid. That's a brutal reality of buy-side M&A advisory. If you don't win the deal, you typically don't get paid.
Well, thank you, Maxime, for this news. I hope you all enjoyed, and I hope to see you in 2 weeks.
Yes, thank you, Jules, for being present today. That's a wrap on episode 2 of The Finance Show. We covered a lot of ground, from a 12 billion euro real estate merger to a Belgian food company leaving the stock exchange after 40 years, and finally to a 22 million euro bet on Belgian tech talent. Hopefully, you walked away with a clearer picture of what's moving in corporate finance right now, both here in Belgium and globally. If you enjoyed this episode, the single best thing you can do to help the show grow is leave us a 5-star rating. And just a quick explanation on how to do it, you need to go to the page of the show itself, not the episode you're listening to. Once you're there, click on the 3 dots and you will find the option to rate it. It takes about 10 seconds and makes a real difference for getting the show in front of more people. We would also love to hear from you. If there is any topic you want us to cover, something you think could be better, or anything you want to share, drop a comment. All feedback is welcomed, whether it's a suggestion, a question, or a criticism. And if you would rather reach out more directly, you can find us on LinkedIn. We'll be back in 2 weeks with more Belgium and global corporate finance news. Until then, thanks for listening.